clicking start streaming, so that way I'm fully prepared.
Okay. Just a moment. I'm just going to test this out. Test it as well here, just to make sure the mic is working.
Sure.
Faizal. Live. Can you see?
Yeah, I can see two watching live.
Alright, so I can hear you.
Should I start now?
Yes.
Okay. Hello. Thank you all for coming to our webinar, and our sincere apologies. We tried to start it at 10:30, which was the given time. However, technical difficulties brought us 29 minutes late. So that's sincere apologies for that. However, we wanted to do this since I wanted to do this, I should say, because the variable interest rate mortgage is a bit of a concern. Rates have gone up several times this year, and there was another 0.5% hike 3 days ago, October 26th. And there's a bit of a concern. I mean, not bit. There's quite large concern of variable interest rate mortgage. Now, before we begin, I would like to take a moment and say thank you to the folks that put this together. First of all, Ayushi, thank you very much for your coordination and bringing the live YouTube to Dominion Lending Centers. I truly appreciate your effort and dedication. Second person is James on my list. And James, thank you for putting this together again. He's the technical person that, kind of make sure that the software is working and all the little nitty-gritty is in action and proper action, all the gears that fit together. And lastly, who has a big part, huge part, who has been working constantly to build this presentation for me, because she does not have any finance background. However, she is a fantastic writer, and she's taken on a project of building slides for me. And it's a bit of a challenge because, being perfectionist, things, it's hard to work with them. They want things certain way. So thank you again for Gillette. So lastly, thank you all three of you to put this together. I truly appreciate your work and effort, and I'm sure our audience appreciates it as well, because this session is all about information, getting ready, because in Canada, the rates, the Bank of Canada's movement, quantitative measures, have taken a sharp turn. They're trying to make sure the inflation is in control, because one of the mandates they have is to keep the inflation in check for the affordability factor for the residents of Canada. And and they have many tools to use. One of them they use is the quantitative measures. So without taking any more time, I'm going to start and jump into this. Thank you again to all the audience that is attending this webinar. I suggest, the presentation will be approximately an hour long. I should add that word, approximately. There may be 5-minute intermission if I need some water or something of that sort, because talking for an hour is hard. I'm sure you all know. Speaking for an hour is quite a bit of work. And please ask questions at the end of the presentation. With technology, the way things are, I cannot see your comments, I cannot see your likes, I cannot see your questions at this moment. However, my goal is to respond to each one of you at the end of the presentation. These 3 folks that are here, they're actually here with me on the Zoom. They will, reach out to you on your messages and comments. So feel free to message whenever you like, comment whenever you like, because typically I use this presentation for Zoom purposes where the questions are at the end. Here we're on YouTube, and I can't really see your comments, your likes, your questions, but I will respond to them. That's one of the responsibilities I will fulfill. So, webinar best practices. Over the number of years, I've developed this slide just to help you stay focused, stay present. Quiet space helps very much. Using headphones are ideal. Turn off your camera, so you're not you're fully there. Silence your phone because calls are distracting. Avoid multitasking. Not just calls, by the way, there are notifications and such. Avoid multitasking, checking email, sending texts and such. That multitasking, there's a very famous person who said there is no such thing as true multitasking. There is definitely an opportunity cost to multitasking, and you don't want to miss this out because there's lots of golden nuggets in this presentation. And my goal here is, if you can take one golden nugget and be prepared for future, my goal is established. So achieved, sorry, I should say. Let people in your physical distance know that you are attending an important webinar. Write down any questions on a piece of paper as you think of them. Yes, you can comment. Yes, you can share. You can like and such. But writing down the questions on a piece of paper will help you further by gaining clarity of your question. And second, if you feel like you're not getting the answer, or when we reach out, you're not able to, because messages, you can only communicate so much. You're welcome to call us, and I will respond to your questions. Stay seated and stay present. When we're seated, we're in a calmer state, and stay present. Focus on what the presentation, because there is golden nuggets here for you. These are some of our social medias. You're welcome to reach out on any one of them. We monitor them. We're not as active, we're not super active as responding, but we will respond the first chance we get. Usually once or twice a day, once a day or once every other day, we do check messages and make sure that no client is unreached. And there's the website, bestrate-mortgage.com. You will get lots of goodies on that website. Lots of things. In fact, Gillette writes some of those blogs on the website, and of course they're checked through and such before they go on. but she does write some blogs, and it's filled with information, lots of goodies for you. Phone number is simple, 416-825-0142. When you call, I'm the person who answers the call. I don't like anyone else answering. I answer the call, so you get to speak to me directly. And if I cannot speak, I will answer the call and say, hey, I'm in the middle of something, I'll call you back, or send me a text. That's a good reminder for me to call you back, something of that sort. I make sure that I connect back with you if I cannot in that time. So today's topic, a massive one: how to handle mortgage interest rate variable. It's having a variable interest rate mortgage. Well, first of all, if you have this mortgage, congratulations to you for owning the home. That's the first thing, because you did work hard to get to owning that home. You made a choice of variable interest rate, which has been the wisest choice for the longest time. Is it not wise today? I would not say so. However, the achievement has to be acknowledged by ourselves, that you have owned a home now, and your mortgage is variable interest rate. So before we sort of look at, oh, this is better, let's jump there, and so on and so forth, let's understand the variable interest rate mortgage first and see what the options are, because these options are different for every person. One size fits all is not the way to go when you're dealing with interest rates. Remember, interest rates, every person's situation is different, and therefore not the same mortgage is not the best for all the clients. It's different for different clients. Now, that's the topic that we're working on today. I'm presenting and giving you information on. However, I'm also interested to see what other topics you'd like to see in the next presentation. And feel free to comment, feel free to message, however you want to communicate, because we're building presentations. This is the very first one. I mean, I've done some other lives, but I think it's the first one on YouTube, and I want to make sure that I cover the topics that you are looking for, because you, the audience, is I have to make sure that I give you what you're looking for in here. So moving on to the actual part of the presentation, which is meat and potatoes, I like to say. So before we continue, here's a 1-minute video, and it's 60 seconds, 1 minute video of Dr. Sherry Cooper, who is the chief economist for Dominion Lending Centers. And I'm so grateful to Dr. Sherry Cooper for taking the time to help Canadians understand how are they impacted by and why. And really, she brings so much value when she speaks. And I purposely, I'll put my phone away. I'll do all the things that I did as a good best practices to make sure I listen to her, because she is she's a figure in financial industry, and we as Dominion Lending Centers, we take a lot of guidance from her. She's fantastic. She's been in the industry for many years. There's I don't know all the details of her. However, she is a fantastic person in the financial industry that helps us understand and translate what Bank of Canada is doing, because we need someone who helps us understand. And here I am breaking it down further to your need. So she's stating some facts about variable interest rate trend, and if this will continue to be a trend. By the way, I am from finance background, and there's a famous quote about the trend is your friend, by Joe. He has written a couple of books, and he's from the financial industry, and he says the trend is your friend. And here you go. I'm going to start the video. I'm not sure. Okay, here. I'm going to just push play and see if it works. Has a different, yeah, I don't. That's fine. I just wanna play. Okay, 1 second. Maybe it's here. Yeah. Can you folks see my screen?
Interest rates were extraordinarily low as a direct result of the easing in
James, can you confirm if folks can see it? What I'm playing?
monetary policy in light of pandemic. The
If they
Bank of
cannot, then we can just
Canada,
skip this
to
part.
cushion the blow of the pandemic, has taken interest rates down to historically unprecedented.
So they're playing it by YouTube.
Yeah.
No, they cannot see it.
Okay, so can we go back to the presentation, the part where I should be? Then I'll just skip this part. Okay, so can I start again? Thank you. She did quickly explain the variable interest rate trend, and we haven't mastered this software to be able to share screen and show you what she speaks. So what I mean, I don't even have, I'm not prepared to have it on a video or on a phone or such. So I'm just going to skip this part, but probably we can work on mastering this for the next one. So what is variable interest rate? Now, most of you know this, but because I'm doing a presentation, I have to kind of go through because there are some points to cover. Variable interest rate changes when the market interest rate rises or decreases. I should have added that on the presentation, but kind of forgot. While your regular payment may seem constant, your interest payment may change based on the market interest rate. It has flexible terms for contract termination, and it is generally lower penalty. Actually, yeah, it is generally lower penalty for contract termination. So those are few things to keep in mind when it comes to variable interest rate. The increase in interest rate means that it will cost you more for the same mortgage loan. The same loan of 400 or 500, if your interest payment was, 3, 4, 500, whatever, I'm just making up a number. Now that cost is higher. That's what the variable interest rate means, because rate is one factor. You have to look at how much of your payment is the interest, and that number really affects you. The rate affects you indirectly. The amount of payment you make to the interest is what affects you more. Sorry, directly, I should say. So Bank of Canada raised its key rate again on October 26 by half a basis points, 0.5%, 50 basis points, 0.5%. It's same thing in two different words. This moves the policy rate to 3.75. And remember, we've seen policy rate as low as 0.25. Bank of Canada will continue its quantitative tightening, which is a short form of QT. And Bank of Canada expects, after this rate rise, Bank of Canada expects 0.9% annual gross GDP growth in 2023. Now, this number was 1.8 from their predictions a while ago. So they were predicting 2023 to be at 1.8% annual gross GDP. Now their predictions have dropped to 0.9%. Now, Bank of Canada, whenever there's a interest rate hike, the first thing you need to review as a client is your budget. Because remember, our incomes are a certain amount, and incomes don't really, they do go up as time goes, but the expenses are another factor, and expenses seem to go up a little bit faster than your income. So you really have to keep an eye on your budget. You must have a budget to work through your financial, pathway. It's a must. And talking about budget, it's an entire topic on its own, and I will try and do a YouTube live for just the budget. Because it's not an easy topic. It's not a topic that's being talked about, and it affects the consumer directly. So moving along, your debt payments will increase together with the increase of interest rate. Remember, the interest rates increase affects credit card rates, loan rates, mortgage rates, car loan rates, student loan rates, any debt. There is some sort of change. If it's not today because you're in a fixed term, it will be at the end of the term, because there will be new rates, and new rates don't necessarily mean lower rates. It most times means increased rates, and specifically we are in an interest rate increase market, so it does mean it's the new rate. The new increased rate is either affecting you today, or it will affect you when the term comes up for renewal. It's going to affect you. It's just a matter of time. For variable, it starts affecting the following month, because by the time Bank of Canada makes the announcement and banks actually implement that, and payments, your statement shows the new rate, it's usually the beginning of next month, is what I've seen. After reviewing your budget, you should, one, talk to your lenders to find out how much your payments will increase if you cannot estimate. So estimating is a good way to go, but not every product that you have has a calculator to estimate. So it's a good idea to ask the lender themselves that, hey, I know rates are going up. One, am I affected? And if I'm affected, by how much? The dollar amount, because that dollar amount matters to you directly. How higher interest rates will impact your budget and savings? It's a good question to ask yourself once you have an estimate as to how it will affect, and what do you need to do to make sure you're comfortable. If you're out of your comfort zone, see how you can reduce expenses or increase income to pay off your debts faster. So those are three things to do, as soon as you review your budget. Use a budget planner. There are some online, and there's a site that we have where the budget planner is accessible. I just don't have the site in front of me, but in the comment section, we will add that as a link, or you can also reach out to us and we'll send you the link, and it will help you figure out things on your own, if you like to do that. If not, you're welcome to call us, and I'll set up a meeting, and I'll go through the tool and your numbers and such. Discuss options with your financial institution or an independent financial advisor. Learn more about mortgage deferrals. Talk to your mortgage advisor to explore different options that are available for you. I mean, mortgage deferrals are not fun. It's not really what you should be using as a first step. It should be the last step. And I strongly suggest you talk to your mortgage advisor to explore different options. Now, regardless of where your mortgage is, it could be at the bank, it could be wherever. If you're not getting the help you need, you're welcome to call us, because we are brokers, and therefore we work with most of these lenders out there. So almost all. So yeah, we'll be able to give you a better snapshot of what your options are if you're stuck in that situation, sort of variable interest rate. If you're in fixed and you still have questions as to how much you'll be affected when the renewal comes, 2 years, 3 years, you're still welcome to call us. We'll run some scenarios, we'll run some future numbers, and we can we have an in-person office, we have offices, and we also have Zoom that is open usually anywhere between 8:30 9 o'clock in the morning, and it goes all the way until 7:30 in the evening. So somewhere and it's also open on Saturday, so somewhere along that time frame we can fit you in. You're welcome to come in. We'll share the screen, we'll show you what the numbers look like, so on and so forth. We have the full system in place. Variable mortgage rate versus adjustable mortgage rate. So when you think about variable mortgage rate, you as a client know that there's fixed rate, there's variable rate, but within even variable rate there's two different sections. There's a variable rate mortgage where the mortgage rate is floating, and it floats with Bank of Canada, and I guess I should say it floats with the bank's prime rate, whichever bank you're working with. And by the way, not all banks' mortgage prime is the same. That is something that didn't happen in the history for a long time, but then has happened with some banks. So you have to really know what their mortgage prime is. Most banks have it very similar or same, some don't. So while mortgage rate is floating and it floats with the mortgage prime of that bank, your mortgage payment is not. What that means is your payment is same, but the interest payment on that interest part on that monthly, bi-weekly payment, that amount changes. That's the variable rate. That's the variable rate mortgage. So the payment that goes out of your bank account is the same. However, part of that is principal, part of that is interest. In variable rate mortgage, when the rates go up, you pay less principal, more interest. Okay, so that's the variable rate mortgage. Now, adjustable, I should have added another section that says adjustable mortgage rate and define that before giving the difference, but we were running out of time, so we kind of just did what we could. Adjustable rate mortgage is where your principal stays the same and your interest changes, and therefore the payment going out of your bank account is different. If the rates go down, you're paying less in payment. If the rates go up, you pay more in payment. The benefit of that is you will finish your mortgage at the time that it is with the term. With variable rate, you may need a longer amortization. There's a bit of a difference. Now, if you don't understand this section or you have questions, you're welcome to reach us. The number is simple, 416-825-0142. Don't think I will answer. Just pick up the phone, 416-825-0142. It comes right on the cell. It's our office line forwarded on my cell, and I answer every single call. I try to, at least, as much as possible. If I'm in a meeting, I'll answer and I'll say, I'm in the middle of something. give me a call again, or I will call you, or text me, some way I will make sure I connect with you. So now here is a bit of a definition and description and helping you understand. Here's an example. So basically it's a lot of words, and I like it just like you. I like it more visual, but we couldn't find a visual. We didn't have enough time to put visual together. So here we've put this on. Let's say you have a 400,000 mortgage amortized over 25 years. Rate is 1.5, which is a dream rate to have today. Interest rates go up to 0.25%, meaning your rate goes up to 1.75. If you have a variable rate mortgage, your mortgage payment would remain the same at $1,599, $1,599 per month. However, if you have an adjustable rate mortgage, your mortgage payment would go up to $1,646 per month. That's a payment increase of $47 per month, and that's only one increase. So it could go up to 150 or 200 depending on how many increases are there. But approximately on your mortgage balance, 0.25% increase is about $50. $47. That's a good number to keep in mind. So every time there's a 0.25% increase, you're most likely paying $47, $48 more. Okay, and of course it's a compounding interest, so it's a little bit more. The more increases that have, the more payment will increase. But it's a good, rough number to keep in mind that 0.25% is $50 on your mortgage if it's 400. If it's 800, of course, it's closer to 100. Is switching from, if you understand that, great. If you don't, feel free to give me a call. I will explain this in more detail for your mortgage. I'll run the numbers for you, and you'll see how big of a difference it could make, present and or future, and what options you have to protect yourself from interest rate disaster going on. Is switching from 5-year variable to a 5-year fixed the only option you have? The answer to that question is no. You have more than that option. Every mortgage is different, and we suggest you call because every situation is different. With the fast rising of interest rates, you're now paying 300 basis points in variable mortgage rates. Higher. It is higher than what you're paying before in 2021. That's an extra $3,000 per month for every 100,000 borrowed. So those are just some numbers to give you. Experts predicted that it will continue to rise for another 145 basis points in 2023. That's another $121 per month for every 100,000. So those are just some approximate numbers. And we wanted to give this slide just so you see how it could get affected, because the increases that Bank of Canada wants to do are not done. We're maybe halfway through or a little bit more, but I would not say we are at the end of it. Should I switch from variable rate to fixed rate mortgage? Well, your monthly interest payment could more than quadruple from January this year to next year December. It actually can, and there's all these statistics and trend that sort of supports it. But if this is the issue you have on hand, we may have a solution. And it's not one solution that fits all. So it's a customized solution for each client. So you're welcome to call us. If we can't help you, we'll tell you upfront. Hey, looks like this is where you are and this is the option. I mean, you will have an option. You may not have something that you like at the time, but is better for you. Or you may, or I may just say, hey, switch to fix. Don't change institutions. Don't do anything. Just call them, negotiate the best, and take it. If I can negotiate for you, I will. So the choice, it all depends on what your scenario is, and then we can go from there. Now, a fact, something that I'm not sure most of you know, but do you ever wonder how interest rates are determined and how banks come up with a certain interest rate on a certain mortgage product? Well, there's someone in the background. There's a financial expert in the background that is crunching the numbers, works on statistics, works on math, works on so many different things. And I'm about to introduce that position to you, just so you understand as to how the rates are being even determined. Because Bank of Canada changes their rate. How is it impacting your mortgage? Like, what's the link? Who is in between to determine that what rate should you be charged, and so on and so forth. So the position is called actuary. An actuary, it's an actuary position, uses math, statistics, estimate the financial impact of an uncertainty and helps client minimize risk. Now, it is a highly paid position who understands economics and is working for the bank. It's not just one person, it's usually a team. And they protect the bank's profits by suggesting what the fixed rate should be for the bank to be profitable. The three things that they work on, I mean, there's many others, and it's a very complex position. I cannot, I'm sure you would not want to, and so am I. I would not want to sit there, crunch numbers, run this, run that, all those models, and I'm not even sure if they have softwares to run it through, or do they do things manually. I'm not sure. But more importantly, for our matter of discussion, they give 3 points. The break-even point, which is no profit, no loss. There's a point above for profitability, and there's a point below for, if the bank wants to use that for, attracting customers or whatever, because there's a term in marketing called as loss leader. Meaning, you have a product that is that runs at a very much of a break-even point, or even at a loss, and that's usually how the clients are attracted, and then sort of go from there. So there's a whole marketing side to it, but more importantly, there are 3 points that they suggest, and then the management decides as to which way to go for each product, and then the rates are determined. They also test the market with certain rates and products and see what's most beneficial to the bank. So that's the actuary's position and work when it's affected, when it's in conjunction for mortgage. Now, our goal. By the way, we have a mortgage app. You can go on the website faizalgarasia.com and you will see the mortgage app right there. Regardless of what user you are, either Apple user or a Google, you have an app that you can download. And our goal is to find the lowest rate for you and fund the mortgage within 10 days from application. That's our goal, and we work very hard to keep that in check. So within 24 hours, we have the application together. We, connect with you back, have numbers put together, so on and so forth. And yeah, within 10 days, we try and have the file ready to fund. So that's our goal. Thank you for attending our webinar, and I definitely would like to see you on the next one. And before you leave, I'm going to switch to the last slide, which is connect with us. You will, there's lots of mortgage tips. There's lots of information on our website, on our social media. Everything that is there, you will benefit in one way, shape, or form. So I appreciate you all being here today. Thank you. And I was able to walk this through without having to take a break. So I'm pretty happy about that. So thank you again. And I shall do this again on a different topic, a topic that you would like. Send us a message, comment, however you want to do it, whatever is most convenient for you. Give us a topic and we'll work on it. Thank you again, and you all have a good day now.